Thank you, Ryan. Appreciate that. Appreciate the warm introduction. Fun fact with me and Ryan, I'd say for about 2 summers straight, UW, the University of Ridge Golf Course, had all-you-can golf from like 4 o'clock until you couldn't see your ball anymore. So we did that together, and we both pursued our favorite hobbies, which was finding balls in the woods. So very often, I would tee off and I would hit one in the woods, and then Ryan so graciously would follow me into the woods with his tee shot, and then it would give us an opportunity to pursue our passion, which was finding Pro V1s in the woods. So every time I see Ryan, it's great. Him and I were able to catch up earlier this week on lunch. So again, Ryan, thank you for the introduction. So Sean Auger, I've been with BDO since 2018. Prior to that, I was with a firm called Smith & Gestelin. A lot of very fond memories of Smith & Gestelin, S&G. Started there in 1999. So I've been doing public accounting for about 27 years. For about 25 of those years, I've worked with Dave Rupp. So that's been a really nice experience. 23. So Dave's the youngster of the group. Another quick, and then we'll get going with this. Another fun fact. For the first time in my life, this week, actually, I got caught in an elevator. So I was stuck in an elevator on Monday. So the Monday after Thanksgiving break, I got in at about 8 o'clock, like I always do. Took the elevator up. Somebody hopped down with me. They got off, and the elevator got stuck. And it was stuck. And I, hit all the buttons, tried to force it open. It wasn't going to open. Was in there for about 90 minutes. So that was a little bit of a traumatic experience. Nothing worked on my phone except for text. So the first person that I texted was Dave Rupp, even before my wife. And I said, "Can you help me?" He said, "Sure." So then he let our office administrator know. And then 90 minutes later, somebody from the elevator company came in and they were able to get me out. I did learn that the building management company can't address elevator issues, only the manufacturer and then the fire department. So thankfully, rep from the manufacturing, the person that installed the elevator, they were on a job site in Stoughton. It took them about an hour, but they got there. I told my wife, who's got a phobia that I can't even describe of elevators, to the point that if it's less than 5 floors, she'll walk, she'll take the stairs. Wasn't going to tell her. I told her. She's like, "Well, what did you do?" I said, "Well, I stood there." She's like, "No, really, what did you do?" And I said, "No, really, I stood there. I stood there for 90 minutes. I didn't have a phone, didn't have any access, just looked at some pictures and just was very appreciative that somebody was in the neighborhood to help." So 2 fun facts. Mark.
Very nice. Yeah, thank you all for your time today. Mark Weisheipl, BDO Capital Advisors. I've been with BDO and its wholly owned investment bank since 2019. So BDO Capital Advisors is your traditional investment bank. We have an M&A wing, third-party sales, and we also have ESOP advisory. There are 17 of us now, and we are only doing ESOP transactions across the country, businesses of all sizes. So again, thank you very much. And to the local market, a couple of them that you are familiar with, we completed the Findorf deal as well as the Vortex deal, and another very large deal as well here in Madison. So the market has been good to us as well as Wisconsin as a whole. Just very good, closely held, family-owned businesses.
And just real quick, we do understand that we're the 3rd session here of 3 sessions. We understand it's just past 4 o'clock. So the slides on our original presentation were about double this. Yes. So we cut it in half, just like Sam cut it in half, hope for some Q&A. But the hope is that we get you out early today.
All right, some real quick basics to start us off. What is an ESOP? An ESOP is not an employee stock option plan. It is an employee stock ownership plan. It was started from the ERISA Act of 1974, and ESOPs are qualified defined contribution plans. And as you can imagine in today's political environment, left and right, no one really agrees on anything politically. ESOPs are the exception to the rule, and for different reasons, which we can get into, but both left and right agree on employee ownership and ESOPs in particular. So let's talk about the benefits of an ESOP, right? When done correctly, an ESOP and an ESOP transaction can benefit the seller, the company, and of course the employees, right? So let's start with the seller and the selling shareholders. They will receive fair market value from a selling to an ESOP. What is fair market value? It's what a financial buyer would pay for the business, not a strategic buyer, right? Because there is no capital coming in to an ESOP. We talked about it, it's an internal. We talked about the internal, external. An ESOP is internal, there is no capital coming in, so you receive fair market value for your shares. There's a lot of misnomers about if you do sell to an ESOP, you're gonna get a lower valuation. And the answer to that is yes and no. If you do compare it to a strategic, the answer is yes. But as the law states, they must pay fair market value for the ESOP. Favorable tax treatment as a seller. So if you sell as a C corporation, there's the ability to defer and potentially eliminate capital gains through what's called Section 1042. So those that are familiar with Section 1031 exchange, this works very, very similar in that if you invest your proceeds in a certain way, you can eliminate upon death. You can defer and then eliminate upon death all capital gains. So this is very, very powerful and one of the many great aspects of ESOPs. Flexibility. You don't have to sell 100%. You could sell 10%, as little, that might not make a lot of sense, but there is no rules that say you have to sell X percentage. It can be very, very flexible as an exit strategy, as a liquidity strategy for selling shareholders. Preserve legacy as an independent company, right? We talked about this a little bit in the previous sessions, right? The potentially not wanting to sell to a third party or a strategic because they want to keep the legacy, they want to keep the name on the door, right? And we see this a lot and more with all of the business owners that we talk to. They want to preserve their legacy and make sure that it's their employees and those folks who help them grow the business to what it is now are taken care of in the future. Retain operating control. So you can, dirty little secrets of ESOPs, you can sell 100% of your business and still maintain control through the board, right? The trustee is the buyer in ESOP transactions. So, but the trustee will not sit on the board. They're just going to ask for some independence to sit on the board. So we will structure our transactions where the board of directors may be 5 or 7, but the internal folks, whether it's family or the CFO or CEO, will maintain majority of the board. So you can actually sell your business and maintain control through the board. So a very, very interesting fact there. And of course, reward employees. The company, potentially, if you sell as a S Corp and you sell 100%, right, S Corps are pass-throughs, benefit plans don't pay taxes. So if you're 100% ESOP, S Corp ESOP, I should say, you don't pay federal taxes, and in most states, you do not pay state income tax. Wisconsin has a little bit of a franchise tax, which I don't want to, surcharge tax that we'll get into. California has a franchise tax that don't go away, but they're de minimis. And then the transactions in the ESOPs that we do that we're going to talk about today are leverage transactions. So I like to say that ESOPs are tax advantage leverage buyouts. And so how do we pay back that debt, that transaction debt? We pay it back because of the enhanced cash flows, because we're not paying Uncle Sam. We're not paying the state of Wisconsin. So that's how these transactions worked. And if marketed correctly to the employee base, right, there's a potential for enhancement of productivity and employee engagement through this added free benefit that the employees receive. Remember, they don't put in capital. It's a free benefit to them. So most of our clients will keep the 401k, will keep the 401k match. The ESOP is completely additive. BDO is now going on 2.5 years, and we're 43% ESOP. We're 43% employee owned. They didn't take away anything. They didn't say, you get this now, you get this retirement benefit. They kept the 401k, they kept the 401k match. So the ESOP is completely additive to our benefits. And then the employees, we've touched upon a lot of it, right, already, but it's a free benefit. They don't put in capital. Hopefully, with a lot of the businesses that you see and that you operate in, what's the I wouldn't say number one, but labor issues, keeping and recruiting talent, right? Especially in contracting businesses, will they leave down the road for another 50 cents an hour, right? Is this another way, on top of being an exit strategy, to retain and recruit your workforce? And we'll talk about different ways to do that here in a second.
And maybe just real quick on that,
Sure, yeah.
on the employee piece, it's definitely an employee benefit, and it's a strong employee benefit. But Mark referenced kind of the messaging. I think he may have said, how you market it to your employees, and that's really vital, because certain employees, that are, say, 25 years old, and this is a retirement benefit. This is something that might benefit them when they're, say, 60 years old. They don't necessarily see the value today. They want to get paid today. They want a higher salary. They want higher bonuses. They want it now, in terms of compensation. They don't necessarily want to wait. So I think the mistake that some companies make is with the messaging, and they kind of try to cram this down the throat, of the employee, that this is a benefit, look at what we provided you, versus, understanding how maybe a 25-year-old thinks versus a 40-year-old versus, say, a 50-year-old. So I think the messaging, of the ESOP is vital. Otherwise, what should be a benefit to the company and what should be received positively can actually have a negative consequence, and it can create problems for the company where this should be celebrated. So,
perfect. So we're going to transition to what is a typical ESOP candidate, right? There is no typical ESOP candidate, right? We get questions all the time. What makes a good business to bring to you, right? Well, let's start out high level. Industry, we're industry agnostic. We've done medical practices. We're looking at a cannabis company. And then, of course, contractors, manufacturers, service businesses. It doesn't matter, right? What matters is these items here, right? Number one, you have to be a C or an S. You have to be incorporated to sell stock to an ESOP, right? So we can restructure to get you there prior, but you have to be a C or an S. I think another very important aspect of this is clean balance sheet, right? If we're talking about a leverage transaction and you already have 2 to 3 times EBITDA on your balance sheet, and then the owner comes to us, owners wants to do an ESOP, sure we can, it just makes it a little bit harder, right? It also affects your valuation, as we know, right? We talked about successor management team with some of the other presentations, and the owner and the owner's time frame. How long are they going to be in the business, right? It's the same situation as our, and I forget your name. Sam. Exactly what Sam just said previous is that if the selling shareholder runs marketing, has all of the relationships, and he's 75 and he wants to go to the Bahamas on his boat, this isn't going to work either, right? There's going to be an employment agreement for a number of years, right? We have to have a successor team in place, just like in all the other situations, right? Preparing your business for sale, it's the same thing here. Minimum EBITDA of around 1.5, 2. We have seen it further south. The reasons for that is the cost to set up and the little bit of the cost to operate. And we just want to make sure that obviously the lower the EBITDA, the lower the profitability, the more suspect they are to market fluctuations, and they can't withstand losing a client or two, right? There's no room. And then has been in business for a number of years, not a startup, right? And then can reasonably, no one can predict the future, right? But if you're in a very cyclical business, up and down, and you need cash flows to repay that debt, might not be the best industry or situation. Questions on that before we jump further? Yes, sir.
I'm in not quite construction or manufacturing, but A&E industry, and I do agree that there seems to be a greater percentage of those entities that are ESOPs.
Yes.
But overall, it doesn't seem like there are a large percentage of businesses that are ESOPs.
Yeah.
Is there a reason why? Or are we going to get to why it doesn't make
It's a
sense?
phenomenal
Yeah.
question. Sometimes I feel like a snake oil salesman, right? Some of the things we tell you, we're going to tell you, too good to be true. I think that's why we're here today, is you're seeing a lot more marketing. You're seeing better service providers. You're seeing these deals structured better. You're seeing them structured for longevity, right? We're not ramming down, over levering the business with a high valuation, right? All the above. But I think it's just education, right? What we're doing here today. But A&E firms are fantastic candidates, right, for an ESOP. So, yes, sir.
So how early are you working with companies that maybe are considering this? Are you coaching them along the way to help them?
Sometimes, yes, but I think we get engaged in I'm looking at, I have an LOI, right, but I've heard about this ESOP, I want to evaluate. Or the opposite, I'm already dead set on an ESOP. Or I think it's a lot of, we'll talk about this a little bit, but we do feasibility studies, right, which is the initial modeling. What is the value of the business modeling? And then sometimes it's a year or two or three before they actually do a transaction. So I'd say in that case, we are getting to them early, but there isn't really it's just conversations about getting there.
Can I ask a follow-up?
Sure.
So you referenced your situation where you guys are kind of in the low 40s right now in terms of, do companies think about going in below 50%? Does it matter from a control standpoint?
It doesn't really matter, and we have so many business owners that say, I want to sell just 51%, I want to hold on to my baby, right? And then they see the benefits of going 100% and how we can make it worth their while through the seller note, through warrants, through earnouts, and it just makes more sense. There's some inefficiencies with being a minority ESOP. You can absolutely do it, but we've closed close to 70 deals in 7 years, and one of them has been a minority ESOP.
No, but I mean, I guess where I was coming from is they want to retain 51%.
Yeah, there's no need to do it because of the board situation that I just discussed. And they actually become quite inefficient to do so. All right, Sean.
So Mark has referenced tax efficiency a couple of times here. ESOPs, if structured properly, are very tax efficient. And just to address, I don't think this was exactly your question, but just to address, kind of the inefficiency of a less than 100% ESOP.
Especially S Corp.
Yeah, so C Corp is different. C Corp pays tax at the entity level. There's not necessarily, distributions being paid. There might be dividends, but they're certainly not needed to pay taxes. So C Corp structure, you might see a minority ESOP a little bit more often. Not very often. I mean, 1 out of 70 deals that Mark referenced, but maybe a little bit more often. For an S Corp, it's pretty inefficient because S Corp, as most people probably know, S Corp doesn't pay tax at the entity level. S Corp passes tax through to the shareholders, and therefore the shareholders need distributions from the S Corp to finance their tax payments. So let's say you got a 50% ESOP, 50% owned by a shareholder. That shareholder then has tax that they have to pay. They have to take distributions out of the business to pay that tax. S Corp distributions are required to be equalized. So now you got the ESOP participating in that distribution as well, and it becomes a real issue with cash flow. So for the most part, S Corps are 100% ESOP owned. The other piece of that is obviously if it's 100% ESOP owned S Corp, there is no tax to pay. So then there's really no need to pay distributions. So the cash for tax does not leave the company. And what we've got on this slide is an example of that. I think if you proved our math might not quite work. But what it's trying to illustrate is the savings that an S corp would see from being 100% ESOP owned. So say you've got an S corporation, that makes historically, say, $1 million. So you got $1 million of taxable income, historically owned by, say, 2 shareholders that live in Wisconsin. So those 2 shareholders, their effective tax rate, if they're involved with the business, is probably going to be somewhere in the ballpark of, say, 38%, if it's a company that's eligible for the QBI deduction. So 38%. So they make $1 million, and that $1 million then they keep $620,000 or so in their pocket, and $380,000 goes towards taxes. That same company that makes $1 million, and those 2 owners decide that they're going to convert to an ESOP, when post-conversion or post-transaction, the tax goes away. So the $1 million that company makes stays $1 million. There might be, if they're in multi-states, there might be surcharges or certain entity level state taxes, but generally that's going to be really insignificant. So for the most part, that company, as a 100% ESOP owned S corp, has become tax-free, and those dollars that were used to pay tax get converted to pay down the debt that was used to finance the transaction. And ultimately then, the tax is used to pay back the bank, the tax is used to pay back the selling shareholders via the seller notes that they've taken, and then the tax that used to be incurred ultimately gets redeployed as a benefit to the employees. Because once that debt is paid off, there is no tax, you got debt that's paid off, so your cash flow goes up quite a bit. And that's how you then essentially finance your participant employees when they're at retirement age, and this is a retirement vehicle, that tax-free kind of debt-free existence then allows those dollars to be reshifted to employee essential buyouts as those employees are retiring. So Mark touched on this earlier. There's an added benefit for C Corp ESOPs. So, and this is a benefit for the selling shareholders. So oftentimes what we see an S Corp approach us and say that they're interested in the ESOP concept. And we say that's great. And then we have a conversation, and then we suggest, what we call a phase 1 analysis, which is kind of just a feasibility study. And that feasibility study might go down different paths. It might be a path of, okay, is there an employee buyout that could be a consideration? Is there a third-party sale that could be a consideration? And then third, is there an ESOP that could be a consideration? So we can lay that out and be quite thorough, with that analysis. If that S Corp decides that they're going to go the ESOP route, oftentimes we'll at least suggest, and we can model out, is that they convert to a C Corp, because as a C Corp selling shareholder, any gain that would otherwise be incurred on the sale of your stock to the ESOP is deferred. Kind of like the like-kind exchange that Mark referenced earlier. You take your proceeds, I think you take the gain element of the proceeds, and you invest those in eligible stock, so kind of eligible replacement property. And there's a whole bunch of eligible replacement property in the stock market. And if you do it the right way, there's some hurdles and hoops to kind of jump through. But if you do it the right way, that tax that would otherwise be due, that capital gain, oftentimes long-term capital gain, that gets deferred. So that gets deferred via Section 1042 of the tax code. And that deferral can be temporary, or that deferral can be forever. Temporary is if down the road, you've got your investment and you need cash, so you need some liquidity. You could transfer those out of the kind of 1042 bucket and into your personal bucket, and then you can spend that cash. If you do, then you're going to have to pay capital gains. If you instead, and this is long-term for some people, a little shorter term for other people, if you die and those funds are invested in that 1042 bucket, you get a step up in basis, and that capital gain that would otherwise have been incurred is permanently, I wouldn't even say deferred, it just goes away. So that efficient for tax reporting. If you're an S and then you go C, you got to stay C for 5 years, or 5 tax periods. So basically 4 years plus a day. And if you do that, then you can reconvert back to an S, and that's ultimately where you want to be, an S as an entity, because again, the S, unlike the C, is more tax efficient, essentially tax-free.
We can bring the taxable income very, very low with some deductions on the C Corp, right? But very difficult to completely eliminate, and there's impact to doing so, of course.
Yeah, we talked about this. I don't think we got to revisit this. This is the 1042. Before we go, I do want to talk through. I'm all about the employee. I've been all about the employee for a long time. To me, like in public accounting, and this is probably any business where you have competitors. You know, the firm or the company that retains their employees over the long run is going to win. You know, to me, if you've got a place that people want to work at, and you treat them right, and you treat them with empathy, you know, you expect, you know, performance out of them, certainly, but you kind of do it the right way. Retaining employees, to me, is the game. It's the whole game. You retain your employee, and then it's going to be better customer service, better customer retention, everything else. So when we went ESOP, and we went 42% ESOP, you know, we were very purposeful locally here in Madison. We got up, Dave and I and a few others got up in front of the room and introduced the ESOP. We didn't want to overplay it. You know, we just wanted to state that this is a benefit. It's a good benefit. It's a real good benefit. I represented that for some, it's going to be their biggest benefit at retirement. It's going to be bigger than their 401k. But it's for those that stay. There's certain vesting schedules, and you know, you don't participate until you're there for at least a year. So it's a long-term investment. But for those that do stay, for those that contribute to the organization, this is a tremendous benefit. But what you want to do is model out that benefit. We target at BDO, we target a 10% benefit for the employee. So an employee that makes $100,000, we target an annual $10,000 ESOP contribution on their behalf. So 10% of their salary, and nothing else goes away. So they still get the bonus, they still get their annual raises, they still get their 401k match, but additive to those other benefits then is the ESOP contribution. And this isn't something that they're going to work at for 3 years and then get a lot of cash. This is a long-term benefit, so we want to message it right. And usually it takes about 2 years, for the ESOP to kind of get some traction. During those 2 years, you see statements, but you don't see much on those statements. The value really hasn't increased. But after 2 years, I'd say, is when you get some momentum. Years 2 to 5, you got their attention. Years 5 plus, it really starts getting some really, really positive momentum. As that loan gets paid down, the value goes up. Those statements become bigger, and it becomes a more significant part of their personal wealth.
Perfect. So now we're going to go talk about what does the cap structure look like on these transactions typically, right? So the graph on the left is the value of the business, so call it 6 times, right? Given the profile of the company, cash flows, what does the balance sheet look like? Of course, industry, customer diversification, et cetera. We believe that it's very, very possible to get 1.5 or 2, all the way up to 3 times EBITDA from a lender, in most instances a senior bank, just a commercial bank. And this is what represents cash at close to the selling shareholders. So typically a 5 to 7 year, potentially 10-year amortization, 5-year maturity. Typical bank loan covenants, except for one thing, right? A lot of the businesses that we look at, A&E being one of them, they don't have a ton of stuff on the balance sheet, right? We go to lenders that are familiar with ESOPs and are cash flow lenders, they don't look at the balance sheet, right? A lot of the businesses we look at don't have stuff, they don't have collateral. So how do they mitigate that risk? They add in what's called an excess cash flow scoop. So 25, 50, 75% of the excess after the year's over and the financials are completed, the bank just says, we're just going to take that and we're going to prepay the principal on our loan. And it's a great way for them to de-risk that bank loan. Potentially opportunity for mezz or unitranche lenders, which we don't really do, but it's very, very possible to combine the senior tranche and the mezz debt with what's called unitranche. And then in all of our deals, right, we're not going to get liquidity out from a bank or a lender of 100% or even 80, right? So all of our business owners that we work with, they're going to have to take debt back, and that's the seller note. So whether it's, we typically say 1/3, we're going to be able to get cash at close, 2/3 is going to have to be a seller note. And there are ways to make that very worth the selling shareholders' time and their energy, right? Because they're going to be unsecured and they're going to be subordinated, right? So that's typical mezz debt. There's a lot of risk associated with that type of debt. So that debt in the market would be 11 to 13% interest, right? Most businesses that I know, right, can't afford to pay interest of 11, 13, even 14%, whatever the market rate would be for that mezz debt. And so we make that up through what's called a warrant, and we'll get into that here in a second. So what is a warrant? A warrant is a right to own equity in the future. So what we're doing is we're modeling a percentage of the cap table that we're going to give to the selling shareholders. So you think about it, of 15, 20, 25% of the future appreciation of the business, right? And the owners are going to get that in cash, right? They're not going to, we don't want to blow the 100% S election. They're not going to receive stock, they're going to receive cash. And the blended return of the interest rate that they're receiving, call it 5% every quarter, every month, plus the potential earning of the warrant, give them that blended rate of return of 12 to 14%. So why are warrants fantastic, right? They're great because they're taxed at capital gains, whereas the seller note interest is capped at ordinary. So you have a interest or a tax arbitrage there. Another great benefit is, if you go back to this slide here on the left, right? If I have a $100 million business and on day one I put $100 million of debt on it, right? What is that company worth? Almost zero, right? There's a little bit of value left over, but it's essentially zero. So the strike price of these warrants are based on the day one value. So if that $100 million company doesn't do anything, their EBITDA stays flat and the market stays the same and all their multiple stays the same, and all they do is repay $100 million of debt, and they have a warrant for 20, 25%, that's $20 million or $25 million in the future without any growth, right? These warrants are uncapped, right? There's ways for them to be put to the company by the selling shareholders, but also the board has a point in time where they're going to say, hey, these are growing too much. We need to call these back and pay you out, right? But back to the value on day one, right? They're a great estate planning tool because you can get an asset that's worth very, very little out of your estate that could be worth potentially millions upon millions of dollars down the road. So a lot of our selling shareholders really, really like this in terms of estate planning, and we work with their estate planning attorneys and advisors.
So how does the warrant value grow if your EBITDA doesn't grow and your enterprise value doesn't grow? I didn't follow that.
Oh, sorry, just by the repayment of the debt.
Oh, simply reducing.
Simply reducing the debt makes the value go up.
And the value goes up more exponentially
if you grow.
Your EBITDA grows.
100%.
Enterprise value grows.
Correct.
And you pay down debt.
Correct.
Okay.
And it's just
all those warrants, please.
Yeah, no, yes. So it's the same thing with the ESOP. Everything is valued once a year, right? It's not publicly traded. It's only valued once a year by the ESOP trustee and their advisor. So obviously the share price for the employee owners, right? It's very, very little to begin with. But as Sean said, in 5 years, 10 years, 15 years, it becomes, right now my ESOP balance is, it's okay. But what could that be in 20 years, right? It could be very, very valuable and could surpass my 401k, which I hope it does. So.
Good follow-up question?
Yes, please.
So the warrant grows in value as debt goes down.
Yes.
Warrant grows as value as EBITDA goes up.
Yes.
And it's part of the initial capital stack calculation, or?
No, that's where you're right, it is confusing. We're going to call these financing warrants. So they're really just a tool to give the holder of the seller notes to make them whole, right? We talked about that they deserve the 12 to 14%. They might only be getting 5 or 6 current pay interest. It's just a way to make them whole. So all we're doing is we're taking their projections, and it's just an IRR calculation of when the transaction debt is paid off, what could that be worth? It's just simply a return calculation with the seller note interest. Yep. Good question though. Anybody else? Okay, we don't spend too much time on this, but this is another important aspect of ESOP transactions. We're able to structure what's called a management incentive plan. So just a fancy word for just a fancy comp bonus plan, right? So management incentive plans in an ESOP context include phantom stock or what's called stock appreciation rights, which you might have heard of. We negotiate this with the trustee. It actually dilutes the ESOP and the employees just slightly. So does the warrant, right? But the reason the trustee as the buyer likes these so much is because think of it as just golden handcuffs, right? You're incentivizing the leaders of the business to stay and grow the company, and they're growing the benefit for the employees, right? So these are, call it structured as 3 to 4 to 5 to 6 year vesting period and then paid out. We usually negotiate somewhere between 7.5% and 15% of the cap table structured as phantom stock or stock appreciation rights. So it's just, if we think about the ESOP, right, which Sean touched upon, it is long term. No one's going to get too excited about it until your account balance grows. People they still want cash, right? So you have your salary as your just base and bonus, and then this acts as your medium term incentive, and then you have the ESOP as the long-term incentive. So with an ESOP transaction with comp, right, we're able to fill all of those buckets, which can be very, very valuable, again, for retaining and recruiting leadership in these businesses. You want to take this?
Yeah, we can. Just real quick, there's a lot of people involved with ESOP transactions. We'll skip this one.
Okay. Just want to touch upon a quick case study of a deal I closed last year. So a very niche manufacturer from a Chicago suburb. They do very, very cool, if you think of firefighters and their pickaxes and batons that they need to bust down doors. So they manufacture those, and they manufacture earthquake rescue equipment. So think of Kevlar airbags that if you have an earthquake somewhere around the world and you have a 10,000 foot beam, and they're able to blow these things up. So just very, very cool stuff. Just one owner, Legacy C Corp, EBITDA of around $8 million and clean balance sheet. So owner was very interested in the idea of an ESOP. He essentially took it over from his father, and he had no children to pass it along to, which is something we see a lot of. We have no children, and or they don't want their children to touch the business, which we've come across a lot, right? So he didn't want to sell to PE or strategic. He might have heard some bad stories, and he didn't want to really put the employees in a bad spot. So we did a feasibility study for them. We really did explore 1042, but he actually said, this is too complicated. I am just going to pay taxes and move on because I think it's better to be an S Corp. And so I'm going to flip to an S Corp. So this transaction, we were able to get debt from a local bank. And then just like we've talked about, right, the rest of the transaction was structured with seller notes and warrants. So just real quickly, we were able to get $14 million. Typical bank covenants, these cash flow loans, their covenants are senior leverage covenant and a fixed charge coverage ratio. Excess cash flow sweep as well. We had to work with their accounting firm to update their fiscal year end. They were a 1031. S Corps need to be 1231, so we had to fix that. And yeah, our final negotiations were with Great Bank and Trust, they were the trustee. They acted as the buyer. In this case, they represented the employees through the transaction. And at $44.5 million purchase price with 21% warrant, 4.5% cash pay interest, and 8.5% MIP plan. And of course, a healthy benefit level for the employees. Questions there? And then we just have one more slide. Yes?
So we've got a peer in our industry that they're about a $25 million annual revenue.
Mm-hmm.
They just went to ESOP this year at 25%. Took them 5 years to get this into place. I don't know details as to why, but talking with the people that are in that pool, they said the mindset of the ownership has changed significantly since becoming an ESOP. Like much more aggressive to meet numbers and just a whole change of mindset. Where would that come from?
Can you take a stab at it? Yeah.
Maybe pressure. You got 30% now, maybe a third bank financing. Maybe they didn't have financing before, so they're not used to bank covenants. So maybe just a pressure that they feel is there today that wasn't there yesterday as a non-ESOP.
And I can jump into it. I think it could just be as simple as they don't want to have their annual share price go down. It should be that.
I'm not sure. They're not sharing everything, obviously, but I ask questions because I'm curious.
Well, they have to. Their statement
Yeah.
would be given to the employees. They would see their share price, and so maybe it just could be that they want to signal health in the business, so they don't want their share price to go down, just like you would in public markets or any other market.
Okay.
But besides that, to Sean's point, bank debt, a lot of these closely held family businesses don't like debt, and then all of a sudden we're putting debt on them, so it changes a little bit.
Yeah.
It forces them to grow up in a lot of ways, right? There might be internal financials, we're getting them reviewed or audited, but I think that just could be a simple answer as not wanting share price to go down.
Maybe that opens up another question
Yeah.
related to that. So it's an annual valuation. Does that vary from year to year and what they're looking for? Is it just standard procedure?
Standard procedure, just a lot of weighted heavily on the future. Valuation is always future looking. They're going to look at publicly traded comps and then transactions in the space, right? What are PE firms in this space purchasing companies at? Looking at the last 18, 24 months, what are those multiples? What are the multiples on similar publicly traded businesses? Obviously haircut for size, but most of it is they're just going to say, what is your business outlook? What are your projections for the next 5 years? And it's just rinse and repeat every 5 years. Or every year, sorry.
No, it's all good.
So is it up to the ESOP then to be able to explain or describe what's going on in an industry that may affect future?
In their industry?
Yeah, in their industry.
I think employee communication is up to the company. That's specific to every.
Maybe I didn't ask that.
Yeah, please.
They provide a forecast to the third-party evaluation firm.
The forecast is going to the third-party valuation firm
Okay.
because the trustee has a valuation firm. The valuation firm, just like in the transaction, they give them a fair market value range, and so then the trustee then sets the price year over year.
I'm not sure I'm asking the question correctly. So the Federal Highway Administration dictates how we do things in our industry.
Yeah.
And we can base workload and projections on the rules as they are now. What if those rules change? How does that get communicated to who's doing the valuation and how that?
Yeah, it's just part of their job. So if it's industry specific, it's just part of their job.
Okay.
Absolutely. If it's industry specific, if their licensing burden goes up or bureaucracy drops, I mean, it's all just part of their job. As they'll have meetings and talk about that every year as to what their business is looking like for the annual valuation. Yeah.
Thank you.
Yep.
Oh, all right. So if sellers remain in the business,
Mhm.
do they participate in the ESOP?
Yes. So if they take 1042, right? Uncle Sam says you can't double dip with this great benefit. But if you do not elect 1042, you can sell your business, you can maintain control and still get shares and probably they're going to be very highly comped, so they're going to get a very large share allocation year over year. So it's pretty interesting. But obviously it doesn't really matter if you're, 70. But yeah. Yes,
Can
sir.
you speak a little bit to the kind of permanence or maybe lack thereof of the ESOP structure? You're obviously putting a decent amount of debt on a business, cyclicality.
Yeah.
How easy is it to unwind of the 70 deals you've done? How many are on the opposite side of the transaction?
Yeah, we've had a couple unwind and we've had a couple just sell.
Yep.
Right? They don't have to be, and a lot of PE firms are actually looking at employee-owned companies because they may, depending upon the culture, right, may have a better, more motivated workforce. So some of them sell, and ESOP does not have to be the last corporate structure. But again, if you are in a dying industry or industry changes and then you have leverage on the books, I mean, yeah, it's not going to be awesome. But I would say the vast majority are thriving. But it also goes to working with good service providers up front to help manage that, set expectations correctly, and educate, right? Putting a bunch of debt on them, maxing out, doing things like just forcing a very, very high interest on the seller note. And there's certain bad apples in the ESOP space, but most of them are very much looking to create very positive employee-owned companies, but for sure.
Maybe just a quick follow-up to address both of your kind of questions or comments. We've done a lot of ESOPs, and I really like ESOPs, but they're by no means perfect. No. We do see challenges with it. One might be cultural. A company that's got a challenging culture, there's a lot of thought out there. We're going to go ESOP and it's going to fix our culture. That's not true. It's not. It might help eventually a little, but a bad culture is a bad culture is a bad culture.
Just thinking that this is going to fix it, no way.
Yeah. And like you said, management philosophy, management attitude, management intensity, maybe change post ESOP. It doesn't sound like for that company it's changed for the better. That's not a good thing. So you got to just keep in mind that the culture you had. Part of this is that legacy kind of continues, and if you change your mindset and you get all, worked up, that's going to, permeate throughout your workforce. Other challenges that we see, sometimes is, you do an ESOP and the 8 shareholders or 10 shareholders get paid. A lot of times there's not clawback provisions, or there are, but they're not really strong clawback provisions. So now, part of the leadership team that you thought might be there, for the next 10 or 15 or 20 years decides that they're going to opt out. I got a very recent example of that, which has been very interesting. Mark knows that one. The other one is, a lot of times the buyers, they come into this and they think ESOP and all about the employees, all about the employees, all about the employees. But then as you start working through numbers, I would say, maybe greed's too strong of a word, but something sets in where they want more. That valuation isn't high enough. I want more. And to Sam, to your point, then it potentially then, depending on how the negotiation goes between the sellers and the trustee, perhaps the debt that's put on the books is a little bit higher than the company can manage, and that creates some challenges. We've seen cultural challenges where maybe you've got a business that's been around for a long time. They got multiple generations of shareholders. And then this generation of shareholder decides, and whether it's ESOP or any other transaction, but they decide.
No, we see this a lot.
Yeah, that they're going to do a transaction. They decide that they're going to monetize, the books, and they're going to provide a current benefit to themselves. A lot of times you see former shareholders, that retired maybe a year before, 5 years before at this level. And then the ESOP, obviously this is all confidential and stuff, but people have their thoughts and opinions. So they retired at this level. Now this group is transacting at this level, and that can create some animosity. So there's some things to consider, I guess, with ESOP transactions.
Yeah, the younger generation who owns 5% would eventually own 40%, and they're upset. Right, because the third generation owner decided to sell, right? How do we make them whole, right? There's only so much you can do, right? obviously, we've seen this a lot, buy in at book value, right? But then now we're valuing the company at fair market value. So there's this complete mismatch of a market, and it's how do you do this? So the older shareholders who own, call it 40%, there's no way now that they want to sell at book value when they know the fair market value, and then the younger generation can't afford the fair market value, and they only want to buy in at book value. So it becomes this mismatch, and we've gotten very, very creative on how to make it worth their while through the warrants a little bit, but there's only so much you can do. And I think that you see that in whether it's private equity, third-party sale, it's just a matter of generational expectations, which you have to find a solution for.
So I know we have 4 minutes left. Mark thought we'd go way short. I told him we'll have plenty here.
I thought we'd be short. So
I thought we'd be
yeah.
short. So I guess we can wrap it up.
Yeah. Anything else,
Final
guys?
thoughts, Mark?
Please. No, I like questions.
So one last question,
Yeah.
maybe just around, do company, and maybe this is just a practice versus a bad habit, but do companies that adopt an ESOP or maybe go into an ESOP have maybe slightly below market salaries, or do they maintain, so it's like a benefit on top of, they're still competitive?
Yeah. So that's all part of the upfront due diligence by the advisor, right? Us, and also the buyer, the trustee, right? So if you have an owner who's running the wife's salary through that, right, and everything's going to be normalized, right? So they're going to have to come down to market salary. So BDO has a great comp consulting group, right? We'll go and what is a CEO in Coeur d'Alene in a manufacturing company? What is their range, right? And I have a client in Coeur d'Alene where we just did this. So alternatively, sometimes they are more focused on the S-Corp distributions and they don't care their salary. So they're only making $100,000 when their market's $500,000. So then we have to adjust our projections we have to adjust them down, right? Because we got to bring them up to market. And so it's just a matter of analyzing and doing your due diligence up front. And it's no different than things that you see. So
It's just a variation of that for just like general staff. Like if it's a company that feels like they can pay below market salary rates for their
can they?
staff, like I guess I'm trying to get into the mindset. Do they still think like if we're offering an ESOP, right, is this kind of extra benefit on top of rolling?
Is this a reason to pay below market?
95% of market.
I can take that real quick.
Sure, yeah.
So what I would, so we're a minority ESOP, and if we tried to pay 95% of market rates to our employees, we'd have an absolute mutiny.
Correct.
Absolute mutiny. And if we try to do it under the guise of this ESOP benefit, we'd no longer exist in the Madison market.
It would just be a bad decision by company leadership. No reason to do so. Yeah.
I think that goes back to Sean's comment at the outset where you're talking to a 25-year-old or a 30-year-old who's starting a family and like a future benefit in 40 years. Great. I have to feed my family.
Yeah.
I have a baby. I have to buy a house, which is crazy expensive. So if you're not able to give them market rates when there's another, whatever your competitor is down the street is, that 40-year benefit down the road.
And that's why I talked about the salary, the short term, medium term, long term, right? This is just, you still got to fill the salary bonus bucket. So.
I was just going to add a comment. I think something that's relevant to all three of the presenters today and the topics today, whether it was Nathan or Sam or you guys, is that the first question to ask the owner or the ownership group when assessing options and succession planning is, what are your goals? Okay, what do you as the owner or ownership group want to accomplish in your 3, 5 year, 7-year plan relative to a sale or transition? And you probably got to ask that group the same question 5 different ways, 5 different times to get to what the real
5.
Okay, 7, 10, whatever.
Yeah, might be a lot more.
What the real motivations are. Because you could have an ESOP conversation with an owner, and they might say, "Oh, that's a great idea. Let's start walk down that path." And then you get a little farther in, and you realize that their motivations are entirely different than what you assumed because of the initial conversation.
Yeah.
So, again, just an observation for consideration.
For sure. And one last plug, I didn't mention it, right? But BDO Capital having the M&A side and the ESOP side, right? Not everyone is sold on an ESOP. Not all situations work for an ESOP. So we'll do what's called a dual track, right? We'll do all the diligence, put together a book, we'll bring the company to market, and then we'll hire a trustee, we'll go raise debt and start the ESOP process and see who wins, right? And that alleviates a lot of the seller's remorse for maybe I could have gotten top dollar here, but I kind of like the idea of an ESOP, but I'm not sold on having a 6 to 8 year tail and payback period, right? Because that's what we usually see. Can't get around that. So that's a negative to ESOP transactions. We can make it worth their while, right? With the warrants, et cetera. But doing the dual track really seems to alleviate a lot of their, plus it gives them the menu of what my options are. So it works out well. Yes?
Yeah, could you just walk through real quickly, employee had an ESOP, they leave. They've got a $50,000 balance.
Great, yeah, good question. If you leave before retirement age, all plans are structured in that you get to wait 5 years, and then depending upon the size of the balance, if it's over, I think, 7,000, you get the chance to pay them over another 5 years. So the idea here is to preserve cash flow and to give you visibility into what you're paying out. So it's not as if someone who has $1 million and leaves before their retirement age, it's not as if the next year the company's got to cough up $1 million. So it's all meant to be sustainable for years and years and years. Sometimes when companies grow too fast, though, right, there's mechanisms to pull it back and to or enhance it, right? If the benefit level is too low and no one's getting excited about it. That's why I think the BDO and 10% is solid. But if someone's getting 1%, right, it's kind of like, but it's just a matter of a lot of the ESOP plan design aspect of it. We talked a lot about the transaction, but the ESOP plan design as well is a whole nother hour-long topic, at least.
Could that
So,
employee roll that into a future employer's?
yes, they can roll it into another. They can roll it into an IRA.
But not a 401k.
But no IRA, I believe. Yep.
Thanks.
Does the phantom stock kind of similarly, it's a payout over time?
It is.
Okay.
Yep. So call it we usually typically do a 3-year vesting
Got it.
and then paid out and then back in the pool. So it's a board decision as to who gets it. So 1 year it could be all Sean, and the next year it could be Mark and Sean, right? But it just keeps rolling. So you can only do so much. So it just keeps rolling and rolling for 10, 15 years, or it could be evergreen where it just keeps going. Yep.
So once an owner decides maybe the direction that they want to go with to become a seller, would they operate, or would the tendency be to operate their business differently if I wanted to go to SAM versus I wanted to go to BDO? Is that kind of the next step that, okay, here's what I want to get out, but if I'm wanting to entice Sam to come in and
Yeah.
help me exit,
Yeah.
am I running the business differently than if I'm going to you guys saying, okay, this is about me exiting, but this is really about my employees?
Good question. Sam, I would say probably no. No, I don't think so. There is no. You still have to run it.
Okay, but
Because in his situation, right, you remember his capital stack, right? There's going to be rollover equity. There's going to be a seller note. ESOP, there's a seller note. We can structure an earn out. So no matter what, they're not getting all of their chips off the table on day one. They have tail, they have risk. So it's just, no matter what, the company still has to operate, succeed, has to function going forward. So I think the answer is probably no. It's the same.
okay, because I guess how I'm looking at it personally, if I'm the type of owner that always puts my employees first and I'm reinvesting in them and the company, that might be looked at differently than if I'm trying to squeeze as much out of the thing as I can.
I feel like that's potentially post transaction,
Yeah, I think
maybe.
also the sponsor will see through that if you're squeezing comp down and you're,
They'll
they'll see through that.
They'll see through it.
Normalize everything to sustainable levels and pay you a multiple on a normalized earnings,
Okay.
which is the same exercise they do.
Same exercise.
Normalizing
Yep.
compensation. Yeah.
Yep.
Okay.
In other words, it doesn't really help to short-term gain for
Yeah.
long, it just doesn't matter. So, all right, cheers, guys. Thank you so much for your time.